So guys, just want to say thank you so much for that wonderful, very sweet introduction. I'm very touched by that, but the truth is that I'm the one who really feels very blessed to be here and in front of you guys speaking today. And I'd like to just take 1 second, just give a very warm round of applause to all of the Quest staff and the people who have put this together. They've done this for you guys, okay? This is a monumental thing to be able to put together, and it's really fantastic, and I'm honored to be here. So guys, my topic is the market update. This is something that I've been doing. I do a market update twice a year, a very detailed one, every August and every February. So as the owner of the Texas Wealth Network and having real estate investor associations all over Texas, I've already given this presentation about 7 times this month. So I'm hoping that I've got pretty much all of this down. But I'm very happy to share this with you. And one of the reasons why I do this market update is not just to share it with the members of my association, but also to share it with myself and my husband as we invest together. One of the things that I read about not recently, but read about was Wayne Gretzky has a quote, and I know we're not a hockey town here, but Wayne Gretzky has a quote. He says, "I don't skate to where the puck is, I skate to where the puck is going." And never is that concept more applicable than for us as real estate investors, because the market is always in some spot in the market cycle. It's always changing. And the assets we hold usually for at least 4 to 6 months on the short end, and we hold 6 months to maybe 6 or 16 years on the long end. So it's really important that we understand where the market is and where the market is going so that we can make good investments and make sure that we don't get in trouble. The last presentation talked about being accurate on your ARV. Never is that more important than when the market starts to shift in a downward direction. So that's one of the things that I want you guys to have a takeaway as well. And as they were talking about the market and where we are, what I want to say is this. You can invest in every single part of the market cycle, and you can be successful in every single part of the market cycle. Will you have to shift and change as we go through different points? And the answer is 100% yes. You have to be open to that shift. You also have to be eyes open to where that market is going. So this is the presentation that I get to share that with you guys. And then for those of you all who stopped by our investor booth for our investor association, which is right outside these doors directly, we can get you a blueprint. This is the real estate investor blueprint. This goes over the 272 different things that we've learned since we started investing in real estate back in 2003. It breaks it down into the different strategies that work in different parts of the market cycle, the marketing that you need to do to find these deals, the analysis and due diligence, the sales and marketing and negotiation, the financing, and then ultimately how to run your business like a business, how to put the hammer down in some cases and start running it not just as a one-man show, but to really grow it. So we'll talk a little bit about this if you join us at the booth as well. The market update for Texas, we've got so much going on right now, but the truth is that a lot of what's going on is the same that's been going on for about the last 6 years. Not much has changed for us over the last 6 years, but we do have some economic indicators that might indicate some sort of a change in the next 6 to 12 months, and I'm going to highlight some of those as we go through the presentation today. So the Texas market 2019 will be a great year. We're not going to see as much growth as what we've seen in the past. The term that the economists who really do a lot of studying for this Texas economy have referred to a term called decelerated growth. So we're seeing growth, but it's just less growth than what we've had in the past. Our state GDP stronger than the rest of the United States, personal income stronger than the rest of the United States. It's no surprise that here in Texas we're pulling up the curve for everybody else and have been for a very long time. Oil prices, which definitely affect us here in Houston and throughout Texas, have been holding steady in that $40 to $60 a barrel range, which is not high profitability for the oil companies, but it's enough to continue to do what they do. It's not high hiring, increases in jobs for those oil companies, but it's enough to not have them fire, and it's enough for us here in Houston to have them to see about an 80,000 plus increase year over year in terms of job creation. Population is booming. Exports are strong, but will definitely be affected by any trade regulations that we put into effect and any tariffs that we put into effect. This is the graph that both excites people and scares people. Since 1950, we have had 11 economic expansions. The average length of those economic expansions has been 61 months long. The current expansion that we are in right now, 121 months long. It is the current record. So for some of you, you may say, yes, winning, this is fantastic. And others of you may be saying, uh-oh, something's about to happen. And it could be any second now. So we'll talk about what some of those indicators, again, as we go through this presentation, will be that might indicate some type of a change in the market. Consumer confidence. What does consumer confidence do for us? It basically says, I want something. Do I want to open up my wallet to get it today? Yes or no? How confident do I feel in my job? How confident do I feel that I'm going to have that job in the future? How confident do I feel in the stock market or my wealth? How confident do I feel in the real estate market? All of these things are things that direct whether or not we buy, and a lot of it will definitely affect us in the real estate market for the things that we are considering buying and selling. I want to just notate that this chart goes back to January of 2007. So you can see where consumer confidence was in the last market cycle. You can see how it dipped during the Great Recession. You can see how it's come up over the years. We had a big boom when oil and gas was trading over $110 a barrel. We had a little bit of a slowdown when oil and gas started to trade at $36 a barrel. We had a big run up after the last election. So that's that big spike that you have there. And then it's always usually up and down, but when consumer confidence is good, this is kind of the backbone of our society, this kind of trust that's built up that allows us to feel comfortable, that allows the economic machine to continue going, and allows the economics to continue to go as well. Some of the leading factors that we've had, or the leading index that we've seen, and what we've looked at over the last several years, it lists these 8 different things that affect the Texas Leading Economic Index. You can see back in the tech boom and the tech bust. You can see where we were in the Great Recession. And you can see where we were in the last oil boom and the last oil bust and where we have been historically. Overall, this is, as you can see, very strong, even over the last many years that we've been watching this particular index for us, and this is a strong indicator of how Texas is going to continue to perform. Oil production here in Texas is very strong. Many of you guys are very aware of the fracking industry that has allowed us to produce more at a lower price. So you can see the price changes that we've had historically, especially the big run up going up to over $110 a barrel, and the big run down almost immediately after going to $36 a barrel. And you can see how that has affected our production over time. As the price per oil has gone down, we produce a little bit less. As it goes back up, we want to produce a little bit more. The United States is the #1 oil production country in the world right now, and obviously Texas and the fracking industry has a huge amount to do with it. Jobs, we have job growth like crazy here in Texas. You can see the historical nature of it going back all the way to 1990. The prediction for 2019, according to the Texas A&M Real Estate Center, is that we should see about a 2% increase in employment 2018 over 2019, which is not as good as what we saw in 2018, so it's a little decelerated, but it's still very strong. And where are we moving? We're moving to Houston. I love coming here, going down I-10 and being on 8 lanes of highway going about 75 miles an hour. But the sooner that we double deck I-10, the more realistic we'll be about what's going to be coming here to Houston specifically, as well as Dallas, Austin, and San Antonio. Right now, 87% of the population here in Texas is in that 67% of the population that we have is in that urban triangle, and 87% of our population is east of I-35. Going over the next 40 years, we're expected to see 90% of that population in this urban triangle, 90% of the population, most of that, again, east of I-35. You can see specifically for Houston, Dallas, Austin, and San Antonio, each of those different major cities are expecting population growth somewhere between 1 million and 3.5 million additional people in this area. Texas has doubled in population every 30 years since Texas became part of the great United States of America, except for 2 30-year periods where it came really, really, really close. And Houston has seen that same growth and is expected to see that same growth going forward as well. Our sales, what does that look like? And I think one of the big things is, what do we expect that to look like? We all want to know what's going to happen with the market. This is what has historically happened with the market. So this chart goes back to 1990, so you can see the sales that we had. The sales are in green. You can see the big run-up that we had during the last market cycle, where we actually had a volume bubble. So, oops, I'm going to try and, oops. I don't think this one has a pointer. Well, you can see the big jump that we had there. So we were selling about 300,000 homes during that period in 2006. You can see that that was primarily, again, a sales bubble. We sold more houses, but we didn't see a huge pricing bubble here in Texas, right? Right now, we are not in a sales bubble. Instead, we are in a pricing bubble. What is facilitating this pricing bubble that we are in right now? Some people will say low interest rates. Some people will say great job creation. Some people will say great migration, people moving here. Some people will say consumer confidence, right? All of these things add up. Another big thing that we are seeing, not just here in Houston, but really throughout the major cities in Texas, is very low inventory. So when you have very low inventory, you're seeing houses that go on market with multiple offers above list price, right? Some days the first time that it's listed, in some cases for some buyers who have been beaten out of other properties, sight unseen, they're putting offers on these properties. A lot of that is driving up these prices. And that's why for us as real estate investors, watching where those interest rates are and where they're going and understanding where they're forecasted going will have an impact on us as real estate investors in terms of the houses that we sell and our ability to sell them. The average price from 2010 to 2018 has gone up 49%, and the median price has gone up 59% just in that 8-year period, and of course is predicted to go up even more. Basically the same chart as the one that I just showed you. What I want to highlight here is I've got a red line going across the left-hand side, and on that left-hand side, that's basically the curve of what our price growth was for our median home prices going from 1990 to about 2007. So you can get an idea for the slope of that curve, right? It's probably about a 40 some odd degree angle. Now, if you look at the price growth from roughly 2012 to 2019, that is a very different curve, right? It's almost straight up, it feels like, and that's the type of growth that we've had over this time period. So that's one of the reasons too why I think that we are not in a volume bubble, because the number of sales that we're seeing right now is driven directly by the number of people who are moving here, is driven directly by the jobs that we're creating and the low unemployment that we have, among other things. But right now, the price bubble has been driven a little bit by having those very low interest rates. Right? When you have a 1% decrease in interest rates, guess what? You can afford about 10% more in the value of the house because of where that monthly payment is. So we are very much affected by that, and we have been able to allow this number to float over the last several years because of that low interest rate that we have. That being said, we are not seeing our household income keep up with the average prices. So you can see with the median prices. So you can see So you can see the median prices have had a 226% increase versus the nominal household income, 129% increase. It used to be, going back to example 1989, that the median price as a function of household income was 2.65 times household income. In 2017, that number shifted to 3.76 times household income. Again, another reason why we could allow that shift is because of these lower interest rates that we're having right now. But it is getting a little out of range. In the last bubble, for example, in California, that number was 16 times the median household income. So even though it's significantly higher today, it's nowhere near what we've seen in other market cycles. So something to be aware of and not to be particularly worried about until or unless we start to see some major changes in interest rates, which we will. And also remember in 1989, what were the interest rates? They were significantly higher. So of course you could afford to pay less, but this graph just kind of keeps us in check and has that knowledge for us. Building permits. So we talked a little bit about, and some of our last panelists also mentioned, that there's very little inventory. In fact, here in Houston, there's about a 4-month supply of inventory of homes for sale. They consider a balanced market an inventory level somewhere between 6 and 6.5 months of inventory. At 4 months of inventory, we're not balanced. We're very much in a seller's market. At its low in the Houston area, we were down into the 3s. Right now, just to also give you guys perspective, Austin is in the 2 to 2.5 range in terms of months of inventory. It is also very much a seller's market. But what's interesting is this. You would think with inventory so low, what would you think builders would be doing? I don't know, building, right? You'd think that would be happening. But what we're seeing right now is builders are not, thank you so much, I've got one right here. Oh, thank you. Oh man, water for everybody right now. But we're not seeing that same growth in terms of building permits and in terms of building as we have seen in the past. So this chart shows how many houses we were building, for example, in 2006. We were at about 166,000 units permitted, okay? Today, even though we're selling about 50,000 more units a year, we're building about 40,000 fewer houses. How does that make sense? If you were a builder, wouldn't you be out there filling up all the space? Well, what's going on with building right now? What's going on with new building right now in the suburbs as an example? What's happened with the cost of land? It's gone up significantly. What's happened with the cost of materials? It's gone up. What's happened with the cost of labor? Gone up significantly. So when I first started investing in 2003, the builder that I was working with said, Shenoah, we can build you a property for under $70 a square foot. Today in Houston, that number is closer to about $125 a square foot. Today in Austin, that number is closer to about $170 a square foot. Why has this happened? Why has this happened? What's changed? What's changed? Labor, yes. What has changed though? Where are we sending people right after they get out of high school now? We're sending them to college. We're sending them to college for 4 years, yes? So they can get a good job, right? And in some of these cases, they're getting maybe $100,000, $200,000+ of debt, and they're coming out of college and only making maybe $50,000 a year. I'm going to tell you guys a little story. A friend of mine is an orthopedic surgeon. We were over at his house for dinner a few months ago. It was a dinner party. He had a plumbing emergency in the middle of the dinner party. What did he have to do? He had to call a plumber, right? Plumber comes out in the middle of this dinner party. We've got an urgent problem here. Plumber fixes everything, hands the guy a bill. Orthopedic surgeon looks at the bill and says, holy cow. Looking at the price per hour, you make more money than an orthopedic surgeon. And the plumber said, I know, I used to be an orthopedic surgeon, right? Do plumbers make a great living? And electricians, yes. And do they make a lot more money than some of these kids that were just now getting out of college with all of this debt? And do they make it with a lot less debt? But have we socialized and including me, when I grew up, there was no stop between high school and college. I was going to college. And that's what we tell all of our kids, right? You're going to college because we want you to get a good education, because we want you to get a good job. And that mindset has shifted people to go to college and taken a lot of people out of the trades. And that's why today, a plumber makes more per hour than an orthopedic surgeon. But that's how does that affect us? How does that socialization affect us as real estate investors? Well, our build cost goes from $70 a square foot to $125 in Houston and $170 in Austin. These things have an impact on us as real estate investors. We may not realize it yet, but it's something I want you guys to be aware of. So the builders are saying, I would build more houses if we had lower cost of land. I would build more houses if we had lower labor. Here's the other interesting thing that's happening with building houses. When I first started investing in 2003, production builders could get a house up between 5 and 7 months. Okay? What's happening with building today? A production builder is now taking at least 7 to 12 months. Why? Again, the labor. It's not as well trained, and it's not as much available. So there are more mistakes, and it's a higher cost. So the builders are a little nervous about building all of these houses because the price, these new home builds, I remember when I first started investing, I'd see new home communities starting from $160,000. And today, all of these new home communities, you're seeing at least $250,000 to $300,000. So that's one of the things that's having a lot of the builders put the brakes on in terms of what they're doing. So that's why we're not keeping up, even though we're selling more with the number of permits and the number of buildings. The other thing that has changed is this: demographics and preferences. So while we're not building as much single family, what are we building a lot of? We're going up, we're going vertical. Look anywhere around in the 5 miles that we're at right now, everything is going vertical. As a Gen Xer, to me, winning was a big house in the suburbs. To a millennial, winning is a condo close to downtown. Yes? And renting and not being detached from their device, right? So when I turned 16, I sound like I'm 100 every time when I say this, but I was at the Department of Motor Vehicle, I was getting my driver's license that day. And now a lot of the millennials, they push that off and push that off. So is that going to cause a swing in terms of the number of new houses that we build versus the number of new multifamily units we build? And the answer is yes. So we are seeing a big swing there. We are building more multifamily today than what we built in the last market cycle. And that is all driven by demographics and also driven by the fact that our millennials, they already have the equivalent of a house in terms of their debt. It's called their student loans, right? So that's also the thing that's pushing that shift right there. Year to date through July, our sales are up for single family or for all asset classes, up 7.5% last month, up somebody help me with this, 1.6%, average price up year over year and year to date. The one thing that we saw a dip in is the sales of townhouses and condos. Here's what I want to tell you about townhouses and condos. They say that condos are the canary in the coal mine. The condo asset class is usually the first asset class to go down when the market goes down, and it's the last asset class to go up when the market goes back up. This is one of those early indicators. And we've been watching this for the last 9 months, and we've seen a slowdown in the number of sales year over year and year to date. So it's one of the things that we're watching specifically as we look for where the market's going. Months of inventory, talked a little bit about this already. You can see where we were in the different market cycles. You can see where we were in a balanced market. You can see how high months of inventory was in Texas at the bottom of the last market cycle in the Great Recession when we were almost up to 9 months of inventory. You can see that after 2012, 2013, we started to go below that 6-month of inventory mark, and we have been in between that 3 to 4 months of inventory ever since, and that has not changed for us here in Texas. And that, again, is one of the big reasons why we're seeing that increase in price because we have so little inventory that's creating more competition. The forecast for 2018 versus 2019 from the Texas A&M Real Estate Center by major market is on this screen right now. So again, they do forecast we will be up in terms of sales, but it's decelerated versus what it was last year. It's half of the growth versus what we had last year. But the good news that I have to share with all of you guys today is what? Is that number is positive. And that's something we should all be very happy about. Dallas, they projected a 3% increase in year-over-year sales in 2019. Dallas was the first major market in Texas since 2010 that had a decrease in year-over-year sales from 2018 versus 2019. I'm sorry, 2018 versus 2017. That's kind of a big deal. Because with the exception of Houston, Dallas is the bellwether for the rest of Texas. How Dallas goes, usually so does the rest of Texas. Houston is a little bit different because there's so much more based in oil and gas here in Houston. But sales were down last year for the first time since 2010 in Dallas. So that's another big economic indicator. They project that for Dallas for 2019, sales will be up. But the way that it's been going so far year to date, sales are down about 3 to 4% in Dallas. San Antonio is up, Austin is up, and Houston is up like crazy. And I'm going to show that to you in the next couple of slides as well. Are we creating jobs here in Houston? Like crazy. The Houston metro area through May 2019, over that 12-month rolling period, had a 2.6% increase in jobs, almost 80,000 new jobs here that were created. Employment right now is at 3.1 million, a little over 3.1 million, the highest point on record. And at the current pace of growth, the region should top 3.2 million jobs by year's end. So people are moving here, people are creating jobs here, there's a lot of opportunity here. In fact, I want to just notate that we're seeing a lot of curves inverting right now in terms of what is normal. And we're going to talk a little bit about the 10-year Treasury note versus the 3-month Treasury note, but I also want to talk about the jobs as well and the inversion that we're seeing in jobs. Last month, there were more help wanted signs than there were people unemployed. There were more help wanted signs last month than there were the number of people that were unemployed. We have like a 3.2% unemployment rate here in Houston, and basically about the same for Texas. The government says full employment is an unemployment rate that's about 6%. So we're more than double that, right? Or more than less than that. So that is an interesting thing. If you don't have a job, it's quite simply because you don't want a job. And in truth, I mean, I would guess that everyone in this room does not want a job, right? So we could be included in that figure there too. Let's see, we do have some headwinds for us, trade regulations, trade wars, lots of different things that the administration is doing. And I'm going to tell you just a little small anecdotal story when it comes to whether or not government has an effect on us as real estate investors. And you heard the last panelist talk about how government changed for us in Texas, the laws changed for us in Texas, and in basically 2005 wiped out our ability to do lease options. About a month and a half ago, I don't know if you guys remember this, but President Trump announced immigration raids. Does anybody remember that? Does anybody remember that? No one remembers this. Okay, some of you do. Some of you do. So I'm going to tell you something anecdotally that happened to me on one of my renovation projects. The week before they had announced those raids, I was getting one of my projects painted. And it was a big property. I had about 12 painters in the house. 12 painters in the house. Fixing everything, getting everything, prepping, painting, all this stuff. The day that the immigration raids were announced to happen that weekend, and guess what? They were supposed to work through the weekend. Instead of having 12 people show up, I had 3 people show up. So for me, when I'm working on a project, and I'm painting a house, I'm not checking immigration status at the door. I am checking, do you have a paintbrush at the door? Yes or no? So while I am all about building this fantastic wall, I just want to let in all the people that have paintbrushes and hammers and saws and all of these things that allow us to do what we do as real estate investors. So be clear, guys, that the things that are happening at a high governmental level, they have an effect on us as well, okay? And if we're already in a labor shortage when it comes to the trades, how much more of a labor shortage are we going to be if we stopped all the people who want to come here and do what? Work. So if you think that the cost to build a house today is high, think about what it's going to be as that changes too. So these things do affect us here in Houston and throughout Texas as well specifically, because we've been in Texas, we've had a fairly large advantage of being able to take advantage of this low-cost labor that may change and may have a significant impact on us in terms of the cost of our projects, in terms of the profitability of our projects, right? So that's something I want you guys to be aware of. Single-family housing permits, we talked about this a little while ago, but this is specifically for the Houston market. You can see where we've been in single-family. We are building more, but we're still not building as much as what we built in the last market cycle. Multifamily, we are building more, and it's because of that big demographic shift. The demand is there. Whenever in multifamily you have high occupancy, low vacancy, and increasing rents, what are us as investors going to go out and do? Build more multifamily. And that's where the demographic preference is, and that's where a lot of investors are going. So where are we in the business cycle? This is also one of the other leading indicators to where we are in the market cycle, whether or not we're about to be in a recessionary environment. So this goes back to 2014, so you can see Houston specifically in the business cycle. Oil and gas, obviously here, was trading at over $110 a barrel. So you can see our growth was very high, and then as soon as it dropped to $36 a barrel, our growth shot back down. And then as soon as it started to stabilize in that $50 to $60 a barrel, we got into what we call our long-term growth rate, which is about 4%. And you can see the effect that Hurricane Harvey had on us, where business came to a crashing halt. And then you can see the effect that happened right after, where everyone went out and bought new refrigerators, dishwashers, washers, dryers, carpet, sheetrock, right? All these different things. That was the big jump up that we had there as well. For those of you guys who are interested in multifamily, so these, and I know this is an eye chart, but the source data for this is listed on each slide. This is from CBRE specifically. So you can see the multifamily cap rates for the 3 large cities here in Texas. This one did not include San Antonio, but you can see where it is in Austin, Dallas, and Houston. So right now for a Class A stabilized property, you're seeing cap rates that are about 4 to 4.5% for multifamily. 10 years ago, those numbers used to be 8 to 10%. So today, what that means is you're paying a much higher purchase price today, for about the same series of cash flows, right? And because of that, that cap rate has shrunk to historically low levels. About the same for Class B, and about the same for Class C. which many of us real estate investors in the room are investing in a lot of that Class C and a lot of that Class C and a lot of that Class B as well. Even that Class C property is at a 5.5% to 6% cap rate right now, which historically, going back 10 years ago, you would see this number at least somewhere between 10 to 12%. So that's how much prices have gone up, even for multifamily and even for the lower end multifamily over the last several years, as again, more people are moving here to Texas, and as again, there's been that big demographic shift in terms of what we are wanting. So what are we watching? We're watching limited lot availability, limited housing availability, overall inventory, but this has been something that we've been watching, as you guys saw in that last chart, or one of the last charts where we looked at what the months of inventory has been over the last 4 years. It's been below that 6 months. In fact, it's typically been between 3 and 4 months of inventory. Higher prices, so we do have some affordability issues. And it's funny because when you're from Texas and you've been here for a long time, what do we say? We say, oh my gosh, I remember when in this area in 3rd Ward or in the Heights it was trading for this amount. I can't believe it's trading for this now. It's not affordable anymore. It's too expensive. And a lot of real estate investors have this kind of mindset of oh, it's too expensive, stop investing, right? Let me tell you guys something. Get perspective from the other people that are moving here. About 30% of the room is here from us, who traveled here today, right? Ask anyone in this room who moved here from New York, anyone in this room who moved here from California. This is still, even though it's much more expensive than it was several years ago, this is still the 2-for-1, 3-for-1, 4-for-1 sale in some cases. When people move here from California, and I know some of you guys have, I think when you go and get your driver's license that day, they walk out of the driver's license office and they say, I'm rich, right? Because you can afford so much more. So get some perspective from some of the other people that are moving here, because it'll change the way you look at the market and change the way you look at how affordable the market really is. Increasing interest rates. Is this something that we're watching? Yes. A 1% increase in interest rates can reduce a buyer's purchasing power by about 11%. So if based on the monthly payment, a buyer could have afforded, for example, a $330,000 house. If interest rates go up 1%, now they can only afford about a $300,000 house. Is that going to have an effect on us? Yes. But don't overthink it. Don't overthink it. Some of you guys in here, and those of you with gray hair, remember this. In the 1980s, what were interest rates? 15 to 19%. Did people stop buying houses? No. They were still buying them like crazy. There's one reason why that is. When people are moving here, when people are having families, when people are having babies, when their jobs, are people going to buy houses no matter what? The answer, you got to have someplace to live, right? So don't overthink this. It will have a short-term effect, but it will not have a long-term effect. In fact, my last chart in here, I've got a little something that'll go back to really demonstrate that for you. Concerns about the general economy. Man, with all the news that is out right now about the fear of recession, I feel like I'm rewatching the last season of Game of Thrones. Winter is coming, right? The recession is coming, but most of the indicators look really strong, and most of the indicators still look really strong for Texas. There's, again, just a few that we're watching. We're going to get to some of those slides just shortly. Stock market volatility. This is really how, if you're invested in the stock market, and I'm personally not, and the reason that is got out of the stock market right after I started investing because I live, breathe, eat, sleep, everything real estate. That's all I do. That's all. I'm not going to beat the MIT, Harvard people who are running Wall Street, but I am going to beat the average investor who's investing in real estate, right? I have a competitive advantage because this is what I do all day long. But for those who are invested in the stock market, as an example, what they might be seeing, what they might be thinking is, stock market went down today. How many of you guys said in your mind, or maybe thought about it after, man, the stock market lost 500 or 1,000 points this month. I'm going to have to work another year, right? How many of you guys have said that about your real estate assets? Probably not a single one of you. But when the stock market goes up and down, it has a mental impact on us, and it's also about how wealthy we feel. And when the stock market goes up and down, does that affect our consumer confidence and our desire to open up? The answer is yes. So that is still something that, that we're watching. Of course, the negative press, the recession is coming. Probability of recession. This is the graph that does make me a little bit nervous here. So this model uses the difference between the 10-year and the 3-month Treasury rates to calculate the probability of a recession in the United States in the next 12 months. This chart goes back to 2005. There has been an inversion in those yield curves. It is a very strange thing that's happening in the market right now, where you can borrow money for 10 years at a cheaper rate than you can borrow money for 3 months. This does not make sense. This is not normal, because normally you would say, well, it's riskier the further out it is from today. That's not what's happening now. So this model is predicting that right now we're about a 30% chance of a recession in the next 12 months. So this is another item that we're watching. But again, I think we're relatively in a good spot here in Texas. And I'll tell you why specifically from a housing market in the next slide. This is the total U.S. consumer debt. This is the total U.S. We have more debt today than we had in 2008, which typically makes people nervous. But the composition of that debt is very different today than it was back in 2008. The big increases in debt that we see, student loans, up 126% since 2008. Auto loans, up 51% since 2008. But there's been a decrease by 4% in mortgage loans and a decrease by 6% in credit card debt. So it's not the same mix of debt that caused our big fall in the last recession cycle. Do you guys understand this? So this is actually, I think, a good thing for the housing market in terms of even if we are in a recessionary environment. So guys, I want to go over very quickly the Houston sales summary. So this is from this last month, July. And a huge thank you to Anne-Marie and the rest of the Quest team for allowing me a little bit of extra time to get this data in, because it's not in immediately after the month closes. So thank you guys for being patient with me on that. I've highlighted and circled the things that I think should be important to you guys. Our total property sales in Houston through in July up 11%. Our single-family housing sales up over 11%. So yeah, this market had the highest increase in year-over-year sales in July than any of the other markets in Texas by a long shot. In fact, Dallas is down. Okay? Average price, median price up. Right now we are increasing our inventory. So as we increase our inventory, it becomes less of a seller's market, more of a buyer's market. We're not there yet. But we are increasing our inventory. That's something that we're watching as well. The median and average home prices, so this chart goes back to 2014. It goes back 5 years, so you can see the growth in both the median and both the average prices, about $50,000 over the last 5 years in both of those different categories. Single-family housing sales also up, not strong, not a huge amount of growth, but still very consistently up year over year. And that doesn't, and what I find fascinating about this market is it doesn't matter if price per barrel goes from 110 to 36, we're selling more houses. It doesn't matter if a hurricane of epic proportions hits us, yeah, we're selling more houses. So that's one of the things that gives me a lot of confidence specifically about this market. Now, condo sales. And I told you guys, condos are the canary in the coal mine. Condo sales are down. Now, in July, they were up. But 8 out of the last 10 months have had a decrease in sales in the condo market. So again, that's one of the bellwethers, one of the things I want you to be on the lookout for. Some of our big market drivers, what's going to determine the economic health of us, of Texas specifically, jobs and income. Guess what? We've got both of those in spades. More jobs, we're creating more jobs, and we have a higher income than the rest of the United States. Demographic changes, right? How are our preferences changing, and how will that affect us economically, and then also how will that affect us as real estate investors? The flow of capital and money markets. So I have been part of and run real estate investor associations since I started investing in real estate. And it's always interesting in terms of my vendor pool or the number of vendors and sponsors that I have. When the market is up, I can't throw a tissue without hitting a hard money lender. When the market is down, hard money lenders don't show up. Now, as you can see here, if you look at the vendors, we have so much money that is looking to be placed. So as long as that flow of money is moving, we're in a good spot. Now, as long as that money is making smart investments, and you heard a lot of the folks up here are very smart about how they look at their investments as well. How is the stock market doing? Even if you guys are not invested in the stock market, it does affect consumer confidence, which does affect people's desire to buy houses, which does affect us as real estate investors. Government, what's the government doing, right? Whether it's an immigration raid, whether it's a wall, whether it's a tariff wars, right, with other countries, that has an effect on us. And considering that if there's a 10% increase in tariffs on stuff from China, I can guarantee you that 90% of what you guys have on and the stuff that is in this room is made in China. So that's going to have an increase on our total living expenses, and it's going to have a decrease on what else we can buy. Technology is changing very rapidly. Open door. Open door. As real estate investors, who are we competing with now? Companies like national companies so there's been a disruption in technology, and we can adapt, mutate, migrate, or die, right? I'm hoping that you guys are going to go with the first 3. They're much better options, right? But you have to understand that technology is affecting us as real estate investors too, and what we were able to buy, how we were able to buy, and we can't just stick our head in the sands, right? Because we don't want to be commoditized. We still want to have different value propositions, which is, I think, what we all are here to learn about and bring as real estate investors. And of course, consumer confidence has a big effect on what we are able to do as real estate investors and how successful our business is. The forecast for 2019 for Houston, growth, right? But decelerated growth. So we're not going to see, even though July was a record month for us here in Houston, we expect to see some decelerated growth versus what we've had in the past. Sales volume should be up at least 2% year over year. That means we're winning as real estate investors. Prices will be up at least 3 to 4% year over year. As long as that inventory stays low, and I should add, as long as that consumer confidence stays high, right? So those are some of the things that we're looking at and looking for. And guys, as I mentioned a few times, I run one of the real estate investor associations here in this market, and we train people on how to invest in real estate. In fact, if you have been to one of my meetings, will you just raise your hand if you've been to one of my meetings? I would love to invite you guys to one of my future meetings. In fact, we have a 3-day training coming up in September, so September 13, 14, and 15 at the Westin, right at Gessner and I-10. One of the things that we focus on, because for us, we have not just survived during different market cycles, down cycles, we have thrived during down market cycles. So one of the things that we specifically teach, we go through 12 different strategies to invest in real estate. We don't just teach you how to be successful today, we teach you how to be successful in every market cycle, giving you strategies and ways to invest in every market cycle. So for me, I've not had to update my resume since 2003. I've not had to ask anybody for time off or vacation or to spend time with my kiddo or to even use the bathroom. I hear that's a thing now. I don't know. At this point, my resume is in some version of DOS that even the techiest of the techie people in this room could not resurrect, and I would not want you to. The secret is having different strategies. The secret is being a student of the market and being humble. The secret is being here today where you guys are to learn about all of these different things. So I invite you guys to join us. We are doing a 3-day training. We never do this, okay? We never, in fact, the people in this room who have attended my meetings will tell you that as well. We've never done this. We will allow you guys to come to our 3-day training. I can't believe I'm saying this right now, for free. And we've never done this. Yeah, thank you. We've never done this. And all that we ask is just stop by our booth, because I can't individually sign every single one of you guys up, but all I ask is that individually you guys stop by our booth. If you can, and stop by only if you can make these dates, because if you can't, then I've got one other option for you. But we'll want to get you signed up for our training, and then as a bonus, what we'll do is if you get signed up for that 3-day training that we have, we're also going to include our real estate investor blueprint. Our blueprint, sometimes people call me the blueprint lady, but our blueprint looks like this. It's a 3-foot by 2-foot poster that, again, goes through all the 272 things that have not just helped us survive, but thrive no matter what the market cycle that we are in right now. So I recommend you guys spending some time getting that education. I recommend you guys spend some time finding different ways to invest, because we are in a changing part of the market cycle. And I think it will help you guys be more successful investors as well. Just a couple more things. Man, whatever we can do as individuals and as a community to help others, I love to take those opportunities to do that. It's not uncommon that people ask me for a copy of my slides. I am happy to give each and every single one of you a copy of not just my slides, the slides that we went through today, but all of the hundreds of pages of backup material that was included in me building these slides to give you this summary here today. All I ask is that you make a $100 donation in your name. This is your tax write-off. This is not mine. Make a $100 donation to Habitat for Humanity, whether it's in Houston or whether it's in the community that you are from. Email that receipt to me at info@reahouston.com. I will send you all of my slides and all of the backup material that went into it. If as a community we can impact, and it's intentionally congruent, and we can impact people who need housing, and what I love about Habitat for Humanity is, what do they make those folks do? They make them work for it, and I am a big believer in working hard. So if we can have an impact on them and share some of our blessings with other people, I would love to be able to do that. I'd love to invite you guys to do that with me. That is my charity of choice. Some of the sources that we went through today: Houston Association of Realtors, Texas A&M Real Estate Center, the Dallas Fed, the Greater Houston Partnership, CBRE, and Market Watch. And guys, I'll take some questions. I think, do I have still about 5 minutes, guys? Does anyone have any questions?
I'm traveling all the way from Canada to be here, and I just want to find out, like, what's those 3 days, September 13, 14, 15, what does it cover?
What do we cover? Great question. I'm going to go back to my Exhibit A. So different strategies to be successful in every market cycle, different marketing strategies, different sales and negotiation strategies where we go over the script of exactly what to say, the analysis and due diligence of a deal to make sure you don't get into any bad deals, the financing of a deal, different ways to be able to finance properties using either all of your own money, using all of your self-directed IRA money, or using the strategy that we love, buying subject to the existing financing. And then we'll also share with you guys some of the lessons that we've gotten over the years from the personal business coaches that we've had that have helped to make us successful as well. Yeah. Murad.
Hi, Shenoah. You look amazing, like always.
Thank you.
So the question I have, you know I'm a real estate agent, top selling, and I love selling. Since we're having a lack of inventory and builders are struggling building, and you're absolutely correct. I know builders don't want to even build anything below $300,000. It's kind of
hard to do.
Yeah, it's very
Yeah.
hard,
Yeah.
and it's not really profitable. What do you think is the alternative? What's going to happen when we're running out of inventory?
We've been running out of inventory for 6 years, right? And guess what? We've done just fine, which means our sales have still been up and our prices have still been up. In fact, that's one of the things that have helped grow our prices is that fact. And again, more people moving here, more jobs. And I will say, at 4 months of inventory, Houston has almost double what Austin has in terms of months of inventory, and guess what's happening in their market? Prices are still going up. Sales somehow year over year are still beating the prior year sales. Not by much because there's not much inventory to even purchase, but here in Houston we're actually in an advantage of having, even though we're below that average, still having more, and I don't think that's going to stop us from having good sales going forward at all.
Thank you.
You're welcome.
Do you think that Texas will ever change the law about the lease options, or do you think they're going to keep this permanently going where you can't do lease options?
So the lease option law came into effect in 2005. So as part of our association, one of the things that we have done is for the last 2 legislative sessions, we have hired a lobbyist. And we've marched over 100 investors as part of our association down to Austin to go and talk to the different senators, et cetera, who are proposing different legislation.
Yeah.
These last 2 times, we have been most focused on being able to buy subject to the existing financing. So the deed transfers to you, but the loan stays in the original borrower's the original borrower's name. So we've been working very hard as an association just to protect those rights. But we're also working with our legislature to try and our lobbyists to try and unwind some of those laws because they've had unintended consequences of not allowing that economy to flow between both sellers with maybe little or no negative equity and buyers who have a great down payment but don't have the traditional funding. And who are our buyers with a great down payment who don't have traditional funding? A lot of times they're immigrants, right, who have a lot of mattress money and who could afford a house but can't, because of the system that we've set up governmentally and the legislation that we have around that, can't do that. So it's on our radar as part of our investor association, but it is harder to unwind those laws than it is to stop them. So that's why the last 2 legislative sessions we have been so very focused on just protecting some of the other rights that we have as real estate investors and the rights that homeowners and home buyers have as well through the wraparound mortgage and buying subject to the existing financing.
Because you can help people fix their credit once you get them in the house.
100%.
Exactly, with the credit repair company.
They threw the baby out with the bathwater in 2005 with the lease option legislation.
So that's hurt Texas a lot,
yeah.
not being able to do, investors a lot, because you can't do lease options now.
Yeah. But we have other strategies for that, which we'll talk about actually during our training. So, yeah.
Great.
We got a great workaround. Guys, thank you so much for having me. Thank you, Quest, for allowing me to speak. I just have one last thing to say. I forgot when I asked for questions, I had a prop. And I was going to answer the first question with out of psychic range, but unfortunately it was out of mental range. So the prop, this is going to now just go to my son. Thank you guys so much. I really appreciate it.